Then we can start.
Good evening, members, and the erudite speaker for the day, Amit ji. And it's another warm day for all of us to know yet another topic which is very relevant, but most of us not are very involved with. So that is the specialty of the day. That is speaking on IPOs. So these IPOs we have been they have been around us, especially for last 1 or 2 years, and it is picking up so fast that many of the small investors also are largely into it. So under these circumstances, SIRC is proud to say that we have speakers across the country, and even in some programs we have had the speakers abroad also. And this is another day for us to have a speaker from Gurgaon, New Delhi, to speak on this topic. And I once again very warmly welcome you all, and also Speaker Amit Mitra ji, very warm welcome to the SIRC, sir. So with this, I take the pleasure of introducing briefly the speaker for the day. See, Amit Mitra ji is a senior partner in his firm, and he has post-qualification experience of more than 23 years. He has a rich experience in handling many IPOs as an auditor of the company, and has helped many companies in making them IPO ready. This is most important. He has worked on many listed companies and companies having diversified businesses, including international presence, applying various international gaps. Mr. Amit Mitra ji is a special invitee to the Audit Assurance Standards Board of the ICAI, and is a peer reviewer and a part of FRRG Financial Review Reporting Group of the ICAI. He is an eminent speaker in various forums, including the ICAI. And with this brief introduction, once again, I very warmly welcome the speaker and also all the members across South to this very special evening's deliberations on IPO. Over to you, sir. Thank you very much.
Thank you, Raj sir. Thank you, and good evening to all my friends. Good evening to everyone who's attending. And it is my pleasure to share my views and thoughts on how CAs can benefit in the IPO boom. Let me call it. Excepting obviously today the markets were down, but that is all part and parcel of this. So I hope you will like it. And if there are any questions, please feel free to park it, and we will address all your questions towards the end of the presentation. I will now share my presentation. Is it visible now?
Visible, sir. Please.
Is the presentation visible now? Can I start?
Yes, sir. Yes, visible, sir. You can continue, please. Yeah.
Okay. So India's record IPO boom. If we compare the IPOs in 2021 with, let's say, 2020 or 2019 or 2017 or 2016, all put together, the IPOs that have appeared in 2021, the 2021 number is far more than the let's say last 3 years of IPO put together. And we are talking of a situation where we are trying to fight COVID day in and day out. Another point to ponder is that whether this is an India scenario or how is it in the global market? How is it there in the US? How is it there in the European market or in the Chinese market and all? And so we'll have a slide covering that. So we will probably start from what's happening in the global market, and then what's there in the Indian market, what is the flavor like, and then how is it expected to shape out, let's say in 2022 now. Was it a one-time phenomena in 2021 and then things will phase out in 2022, how is it looking like? And obviously, I understand we have a community of chartered accountants here. We have all our members here. The moot question is, how can a chartered accountant contribute to the IPO process and kind of make healthy money or make good engagements out of this. So I will try and cover possible engagements that we as chartered accountants can be part of the IPO process and benefit out of it. And also, we've been asked questions many a times that what are the broad applicability criteria? There are a lot of criteria which is available in the ICDR, which are available on the SEBI site, and then obviously also available on the guidance note on the prospectus. I will touch upon few basic criteria which are more from a knowledge perspective, just to give an insight as to how these loss-making companies like a Zomato or a Paytm, how these companies being allowed, how do they fit into the criteria of coming up with an IPO? And then a broad high-level process map as to what are the different stages of an IPO, and generally how much time does it take? And then what would be the financial reporting matters generally observed in an IPO scenario? How can a chartered accountant fix this and contribute? So with any roles and responsibilities, there are attached liabilities also in case of, let's say, if something was to go wrong, in case of a material disconnect, or in case of material things which are missed out. So we will briefly touch upon some liabilities which may come up in case of a false or a misleading statement. Moving on the global side, if we purely look at only 2021, the IPO volume rose as high as 64% year on year. So this is the kind of rise that the global has seen on the IPO, and then which has also translated into proceeds also. So there are IPO proceeds which have increased to the extent of 67% year on year, and this is a huge number. This is the kind of deals that the world is witnessing in terms of the financing. And then if we further narrow it down, Q4 of 2021 has been the most active in terms of deals, and it has been the highest in the last 13 or 14 years. This is the kind of volume that the world has seen only in last quarter. I'm talking of only quarter to quarter comparative numbers. And if we were to put some numbers, there have been about 2,400 deals across the world, and a total deal amount ranging to 453 billion US dollars. This is the kind of money which has exchanged hand, or which has gone into the business through the form of deals. Now looking ahead, well, whatever has happened, and that's there in the past. Now looking ahead, there are new headwinds and new tailwinds. How does the scenario look like? Obviously, in the new year, there are both headwinds, there are both advantages, there are both tailwinds, and which are likely to impact the IPO. And then generally, it is a combination. Nowadays, it is more a combination of geopolitical tensions or the inflationary risk, or if there is obviously a new wave in terms of COVID impacting a particular country or a particular state. So it's no more a financial matter. It's become a geopolitical matter, and a matter which is dependent on how the economy will play out. So if you were to see how the new year will look like, obviously the new year looks very bright, but it is dependent on the geopolitical tensions between the countries. It is dependent on how the economy spans out, especially with the impact of the pandemic. And despite of all these, there are relatively very high valuations, and the market continues to have liquidity. So these two important factors, till the time these two important factors are there, one can expect the volume to only go up from here. High valuations means that the investors would want to, or let's say the private equity or venture capital PEVC would want to exit at high valuations which are available as of now, and there is enough liquidity in the market to suck up those equities, those listings and all. And both the criterias are quite relevant as of now, are quite available as of now, which means we have a very bright 2022 ahead in terms of IPO. And there is, let's say, a word of caution also, like we saw today in the market. It was no less than a bloodbath. So any IPO candidate, one has to expect a higher market volatility, and it should remain flexible. When we say flexible, it means there should always be a plan B available. So let's say if the valuations are not available, if Paytm was to come up with an equity issue today, instead of 2,100, probably it may have got not more than a 600 or a 700 rupees. So is there a plan B available, is what the companies should always have in their armory. If the markets are highly volatile, they may want to apply plan B, and where the CAs can contribute. Okay, moving from the global market to the Indian market, we just saw how beautiful the global market has had in terms of the IPO run in 2021. And also we saw that it will continue to have a good run in 2022 also, obviously subject to high volatility, because there is enough liquidity and because the valuations are quite high. Now coming down to the Indian market, we've witnessed IPOs of loss-making technology companies. I mentioned in my initial deliberation, we have loss-making companies like a Zomato or a Paytm or many others, where let's say Burger King was a loss-making entity, and there are many others who have been granted permission by SEBI. The DRHPs were approved, and then those were gladly accepted by the retail participation, as well as there was a very high subscription by the QIBs, and there was a very high subscription by the other participants. So there have been huge listing gains is what we have witnessed in last 1 year. There was a very strong participation from the retailers, and then the loss-making companies have made a killing. Now, when we say there was a very strong retail participation, this can easily be demonstrated from the fact that the number of demat accounts that have opened in last 1 year, the demat accounts have virtually doubled in last one and a half year, which means that there is a keen interest and people think that they can make money. People have the liquidity to invest in the Indian market, and obviously this goes with the fact that what other alternates do they have as of now. The deposit rates in the banks have dwindled to a large extent. The rates have gone down to a level which are even less than the inflationary rates. So there is this push factor also uh, for the people, as to lack of any other alternate, they are going ahead and investing in this. But from a market perspective, it is all good. Now, to give you some numbers, in 2020, there were 15 IPOs which hit the market, and it fetched around 26,600 crore. If we take 2020 plus 2029 plus 2018, total 3 years put together, there were 57 IPOs which fetched somewhere around 73,000 crores. And as I mentioned, 2021 alone fetched over 1 lakh crore with 63 IPOs. So this is the kind of traction that we've seen. And out of the 63 IPOs, 36 were there was a mega response where the subscription was more than 10 times, and 6 IPOs even it was more than 100 times. Okay, fine. Again, as people say, this is all done and dusted. What do we have for 2022? Well, we begin the year on a very bright spot. 35 companies have already got SEBI approval. That means the DRHPs are already approved, and they will come up with listing anytime soon. And the amount of money already looking up for the IPO process is 50,000 crores. Plus, there are 33 companies awaiting regulators go ahead, where they have filed the DRHPs, and the SEBI approval is pending. And plus the big one, obviously, the LIC. So this is all there, which is in the public domain, which is in the know of all of us as to how the 2022 is going to shape up. But everything is not hunky dory. Everything, it is dependent on factors, as I had mentioned. It is dependent on geopolitical factors. It is dependent on the interest rates also. If the interest rates on a fixed deposit or on a saving bank term deposit increases, then there would be many people who may want to move from IPO and then shift back to their fixed deposit. So this will have an impact on the IPO and the valuations part, as I told you. So there are factors which will have an impact. But as things stand, there is a huge market, and 2022 most likely than not will have a better year than 2021. Okay, moving on to chartered accountants. All of us, how can we contribute? We chartered accountants are considered to be the backbone of any company, or for that matter, for any country's economy. And how can we now contribute? So our role is multifaceted in this. Chartered accountants can play uh, a role of a check of IPO readiness review is what we can perform. We can perform various certification services, and I have more detailed slides as we move along. But just to quench your thirst in terms of how can we contribute, the first thing we should try and go and tell our customers is that we will do a IPO readiness reviews for your accounts, for your systems, for your processes, for your corporate governance, because probably we are the only profession who will have knowledge and understanding of each and everything. And the rules are all there. They're all sacrosanct. They're all defined in the guidance note, which is going to be the guiding factors for us, for SEBI, as well as for the bankers. And obviously, SEBI, they are the regulators. They can come up with n number of observations. They can come up with n number of additional requests. That is all adding on to our business. Now, moving on to what roles we can play. We can perform special purpose audits for the IPO. An IPO would generally need a stub period audit and 3 years of restatement. And before we come to that, the IPO readiness, as I had mentioned, which is nothing but a health check of the corporate governance, a health check of various policies and procedures, a health check of the internal controls of the company, a health check of whether there is any risk sitting in the company, how the contingent liability is looking at, how the potential liability is looking at, how is the accounting policies framed, are the accounting policies aggressive, or accounting policies needs to undergo a change, accounting policies are in compliant with excuse me, accounting standards or Ind AS in this case. So all these things is what we can try and sell. Huge number of certifications are required. We can contribute there. And uh, independent directors. So a lot of independent directors are chartered accountants who have a basic understanding and are literate in terms of the accounting, and they understand the nuances of financial statements. That is an important area, and then these independent directors can play a huge role in terms of the board reviewing the IPO readiness, or a board which is approaching to a primary market. Corporate governance, as I've already mentioned, we could act as a huge stick or a huge support for the company. All the CFOs are chartered accountants. CFOs have to play a huge role in the IPO readiness, both in terms of accounting, financial statements and all, and otherwise also in terms of ensuring that the compliances are in place and compliances are operating fine, and the design of the controls are also fine. Restatement, as I had already mentioned, one could help in both preparation of the restatement if one is not an auditor. As an auditor, obviously, you will have to certify on the restatements and provide your examination reports. Okay, so before we drill down further in terms of the contribution by the chartered accountants, eligibility norms. Again, it's very exciting if we were to see how come you have these companies, loss-making entities, continue to be run, continue to be listed on the board. We'll touch upon that. So there are two entry norms provided in the ICDR. One is the profitability route, and the other is, let's say, a route available for loss-making entities. So we'll very quickly touch upon that. In case of a profitability route, the criteria, or let's say the broad criteria are that net tangible asset as should be at least 3 crores in each of the preceding 3 full years. And out of this, not more than 50% are held in monetary assets. However, if the limit of 50% on monetary assets, this will not be applicable in case public offer is made through an offer for sale. And if it is not an IPO, it is for an offer for sale. So that's it. So which means net tangible asset of at least 3 crores, just 3 crores for preceding 3 full years. This is condition 1. Condition 2 is a minimum of 15 crores of average pre-tax operating profit in last 3 years out of the last 5 years. And then the net worth of at least 1 crore in each of the preceding 3 full years. In case of change in the name of the company, in that case, 50% of the revenue of the preceding 1 year should be from the new activity denoted by the new name. And then the issue size should not exceed 5 times the pre-issue net worth. So these are, you would see, these are very, very basic conditions. The conditions have been kept at a very minimum threshold for the companies to take full advantage of themselves getting listed. A 15 crore on average profit, operating profit in last 3 years. I don't think this is quite a big deal, or a net worth of at least 1 crore in each of the preceding 3 full years. These are all very simple and very basic entry norms. Okay, now on the loss-making companies, if they need to go public, there is an alternative route available, which is, now this basically is to provide sufficient flexibility and also to ensure that genuine companies are not limited from fundraising. So what is the alternate available to the loss-making companies? It is always either through banks. You reach out to the banks for your term loans, or your long-term borrowings, or your working capital loans, or your cash credit loans. So which means that if companies are loss-making, or if they are, let's say, progressing from a loss-making and moving towards that, now the SEBI says, fine, we give you a window where these companies are also allowed, and if they are genuine, and then the fundraising will not be limited to those strict parameters. And then they are saying that there could be an entry norm where the QIB route should be far more, which means the issue shall be through book building route only, with at least 75% of the net offer of public to be mandatory allotted to qualified institutional buyers. And then the company shall refund the subscription of money if minimum subscription of QIB is not attained. Now, if we see what is the logic behind this, the logic behind this, SEBI thinks that QIB will have the muscle and the strength to understand the valuations being asked by the company as compared to a retail investor who may not have that kind of capability to understand the valuations being offered by the company. So this is a win-win situation. It gives enough let's say flexibility to genuine companies to be just not limited to the bank funding, or let's say funding through the private sources. They're saying, fine, we will give you this window, but the investments has to be done by QIBs. So what is, if you were to compare the two, where it's a profitable company or where it's a loss-making company? So here you would see in case of a profit-making company, the QIB is 50%. High net worth individual would do up 15%, and retailers, where the biggest difference is, can go up to as high as 35%. And in case of a loss-making companies, that 35% will come down to 10%, and then the QIB limit will go up to 75%. So now you understand the difference between a profit-making company and what would be the share of the retail investor, and what would be the logic behind a reduced retail investor in case of a QIB. I also talked about FPO. I just thought that it will make more sense to have this here, because we are expecting a lot of further public offer in 22 and 23. Again, there are criteria. If the company has changed its name within last 1 year, then at least 50% revenue for preceding 1 year should be from the activity suggested by the new name. This is criteria 1. And the aggregate of the proposed new issue and all previous issues made in the same financial year in terms of issue size does not exceed 5 times the pre-issue net worth as audited as per the audited balance sheet. So even FPOs could go public, and we will see many FPOs coming up, and the criteria are there in front of you, which are also quite simple to adhere to. Right, all offer documents are subject to market risk, the dampeners. Nothing comes without a risk. No investment comes without a risk. And so whatever we have said, if there is a drastic fall in the market, the valuations will come down, and it will hit the market. And we talked about hike in the interest rate. We are already witnessing US Fed rates are about to increase, which were announced quite earlier. It's not that the Fed had announced the increase recently. We are seeing a huge impact because the investors feel that there will be a lot of FPIs who would be pulling out the money and sending the money back to their parent country, which is US, which will impact the Indian market. Omicron has been very unpredictable, though we've seen many states have shown a declining trend, but it still is unpredictable. It may have a huge impact on the sentiment. It may have a huge impact on the economy of a country, as we had mentioned. So this could be a dampener, whether we put it on record or we not put it on record. And then the high valuation is what we have seen. So there were many misses also. I mean, if we see last year, out of 10, only probably 6 IPOs, or let's say 60% of IPOs were there where people were able to make money on the listing day. And there were 40% of the IPOs where people actually lost money on the investing day. And what is the reason for that? If the issue was fully subscribed, that means there was nothing left on the table for the investors to gain for. And Paytm is a living example where it was subscribed. I think it was subscribed to the extent of 1.2 or 1.5%, which means people were willing to buy, but the valuations were so high that no one was able to make money. So if these high valuation IPOs continue and nothing is left on the table for investors, it will play a dampener and people will start losing interest. And obviously, if retail interest is lost, then the IPOs will not continue to be the flavor. And then the post listing, we've seen extensive listing of companies who have not been making money or have been making small money. So the post listing, when they close their first year, post listing is when we are going to see as to how people are going to react, because on one side you will have huge losses sitting on the financial statements, and on the other side you will have huge valuations appearing in the stock market. And there is no way where valuations can be perfectly worked out for a loss-making company, because how would you project? I mean, projections are based on certain assumptions, and if the company is a loss-making company, it is very, very difficult to project with some accuracy. So the market reaction on loss-making business companies listed in 2021 will be very, very important to see. We have results session coming up in the month of April and May. We'll come to see as to how public react to that. We will have listings like Zomato or Paytm or Burger King or Barbecue Nation or Macrotech developers. I mean, these were all loss-making entities who got listed, and we'll have to see how things will shape up. And this uh, let's say experience will lay the foundation of the future of loss-making IPO companies going forward. Okay, so a brief about the IPO process. How does it take place? Obviously, this is all relevant for companies, and I will have certain slides wherein we will share as to how chartered accountants would fit into the role. Though we have had one slide already on a high level introduction as to how chartered accountants would fit in, but just to make the chart clear, let me just run through this. So the first thing is the appointment of merchant banker who would actually guide through the entire process. Then the DRHP is prepared by the company with the help of merchant bankers, or merchant bankers own up the preparation of DRHP. The DRHP is filed with SEBI. SEBI generally takes so 60 days is the limit. So generally these days they uh, turn around within 30 to 40 days. They are quite active these days. So they will have set of questions. They will raise their questions to the merchant bankers. Merchant bankers will respond to them. Merchant bankers will reach out to the company to respond to seek their support in terms of response. So once you get the SEBI approval, after all those questions are addressed, in a maximum period of 60 days, you will have roadshows in terms of attracting the institutions to invest. Then you will file the RHP um, with the ROCs and all, and then prospectus filings are done, and then the issue is launched. So once the issue is launched, you get a window of 4-5 days to get the money from the public, and then there are post-issue certifications like the utilization and all, the, or how the funding has been received and all, and then the funds are received, and then the shares are allotted, the lists are all declared. This is a small process, and now let's see how uh, the planning for IPO is phased out. So if we were to divide the planning for IPO in two phases, which is let's say execution phase and then the planning phase. So planning is obviously the most critical and strategically important phase is an IPO roadmap. Planning would mean who would be your merchant bankers, whether you fit the criteria, whether your financial statements fit the criteria for having an IPO, whether you have a team available inside the company to support the IPO process, be it finance team or whether your composition of board uh, is as per the requirements of the SEBI norms, whether you need certain things from ROC level. Let's say, for example, if you're a private limited company, you may want to convert it into a limited companies, whether you have a good marketing team who is able to support the pre-IPO phase, whether the products are all tracked, whether you have contingent liabilities or court cases which are adequately addressed, um, and then there is a continuous evolution of market dynamics, whether that is being taken care by the IPO committee or the IPO team. And then if there are any qualifications sitting in the accounts, those qualifications needs to be addressed by the board and then subsequently by the audit committee, and then those should be fixed. And then an internal due diligence is generally performed as an important step, which basically helps in identifying the red flags much before the external agencies are onboarded. So this is the kind of activity where our chartered accountant brothers can help and support the management, fix their house. internally. And then when we say execution phase, we mean the appointment of the merchant bankers, the lawyers, depending on where we are pitching for audit. All those are are kind of onboarded, and then we have we could have an in-house team, or we could have an independent team to work as a PMO, which is a project management office, who will primarily coordinate between the multiple teams, which is the lawyers, which is the merchant bankers, which is the company, the auditors, and many other stakeholders, consultants. And market timing is, of course, extremely important, as I had already mentioned. That market timing is important because merchant bankers would want a very high valuation for themselves, and also they also need to ensure that the people who would subscribe to them, they also make money. Because if it is not a win-win situation, then the IPOs will likely fail. On the regulatory side, it is just not the SEBI ICDR or SEBI LODR. There are compliances from the Companies Act side also. We have to ensure those relevant compliances. We have public issue, IPO, right issue, bonus issue governed by Chapter 3, and then Part 1. Then the allotment of shares, prospectus, how prospectus are to be viewed, formed, what are the requirements sitting in the prospectus, and then certain definitions like an expert, who is an expert, what is the definition of the promoter, what is the definition of the network. Many things will flow out of the Companies Act. Many chapters are relevant. Private placement is governed by Chapter 3, Part 2, the Companies Private Placement Act, and all those things. In case of SEBI, one needs to ensure that the conditions are complied with, the procedures, the filings are done. There are various filings with SEBI. Then there are chapters in terms of IPO. We have to follow Chapter 2. If it is a right issue, we have to follow Chapter 3 and all. So like that, there are compliances available. One needs to ensure that those compliances are undertaken. And then the LODR, which is the in principle approval, and then the listing on stock exchange, and after the listing, the compliances need to be considered, like a quarterly review, each time a limited review, or a year-end audit, and the number of days within which it needs to be done. Formation of various audit committees, formation of various committees like risk committee, or an audit committee, or a remuneration committee, or a CSR committee. There are 5 or 6 mandatory committees which are required to be formed. Specifically, if we were to understand the intermediaries, we have merchant bankers, playing the main lead role, like the protagonist of this film, who would be registered with SEBI, and they will do the due diligence and prepare the offer documents along with the support of the company. They are the people who will ensure all the legal compliances. They will do the marketing, and they will do the due diligence in terms of the readiness and accuracy of what is sitting in the DRHP. And then they will satisfy themselves about all the aspects of the issue during the veracity and adequacy of disclosure in the draft document. So they are the leaders. They are going to lead and direct as to what they need. And then the other stakeholders could be registrar to the issue, who would help in the allotment or refund of the investment. And then the bankers will help in mobilization of the funds or the collections and all. And underwriters and legal counsel. Now, statutory auditors. So auditors, they play a very, very special and a very important role in terms of being one of the intermediaries in the IPO process. So the auditors will report or certify on matters as required under the ICDR regulations and as per the guidance note in the prospectus. So let's say, for example, one of the document is called an examination report, which is primarily given on the restated and on the stub period. When we say restated, we mean the financial statements for last 3 years have to be redrawn and then there are 3 or 4 criteria which needs to be adhered to. So there may be a situation where the auditor doesn't have anything in their let's say, and when I say anything, I mean there is no um, gap between what was audited earlier and what restated financial statement would look like. But in the IPOs that we have seen in 2021, there has been a restatement in 100% cases, because there would be things like adherence to the accounting policies. For example, India's 116 accounting policies got applied 2 years ago, and if we are looking at 3 years financial statement, the India's 116 compliance need to be pushed 1 year back. Or let's say, for example, if the company was not following India's and company was following Indian GAAP, in that case, all the 3 years would be restated under India's. What is a stub period? So stub period by definition, or let's say in a layman's language, would mean period starting from the last audited balance sheet till a particular period end, but which is less than 180 days from the filing of the offer documents, which is let's say a DRHP and then RHP. So examination report is like an auditor's report, which is to be issued on the restated plus the stub period. So that means this examination report will be report covering 3.5 period if September 30 is our stub period for now. Consent letter is another document which needs to be executed and given by the statutory auditors. It is basically a consent given to the BRLMs, the bankers and the company, that they can use our name and they can use us um, as experts uh, for the DLHP purposes. Comfort letter basically is given to the BRLMs, um, which primarily will contain comfort on areas as desired by BRLMs. Let's say, for example, BRLMs would want us to circle up on the accounting numbers appearing in the DRHP. So the auditors would do the circle up in the DRHP and report as part of their comfort letters to the BRLMs. Arrangement letters, it is loosely considered like an engagement letter where certain terms and conditions and roles and responsibilities are defined. The templates of all these are available in the guidance note. There is enough information available in that, and also one can have a look at the documents filed in the SEBI website. Obviously, comfort letter will not be there because those are comfort letters issued to the BRLMs. But the templates are available in the guidance note. These statutory auditors would be required to certificates. And then the guidance note describes that the auditors are recommended to restrict themselves only on the accounting matters, and they should not be certifying legal matters, because we are not expert in the legal matters. And so whatever is recommended is also kind of mentioned in the guidance note. So from a BRLM's perspective, or let's say from a merchant banker's perspective, they would want statutory auditors to certify anything and everything on earth. They would, I mean, if you ask them, they would probably ask 30, 35 or 40 certificates from the chartered accountant. One needs to be clearly wary of the fact as to what we are certifying and what we can certify. As I had mentioned, something like a legal matter, we should not be opining on. We are not competent enough to do that. Other things which are not flowing from the financial statements, let's say, for example, number of branches, or let's say things like this, is a quantity of fixed assets. These things are not available in the financial statement. We should try and refrain from certifying these. So probably what we have seen is, if you see the documentation of how the larger firms do, they generally do not certify more than, or let's say they do not give more than 8 to 10 certificates out of the 35 or 40 that generally is asked for. Now, what happens in a situation where there are joint auditors? Now, in case of joint auditors, again, similar to SA 299, the report should be signed by both the auditors, which is in accordance with SA 299. And the important requirement from SEBI's perspective is that the auditors should be a peer-reviewed firm. Only a peer-reviewed audit firm can do the IPO work or IPO certification or issue the examination report or consent letter and all those things. Now, what happens in a situation where, let's say, there are new auditors who have done 1 year, let's say March 21, and are peer reviewed, but the previous auditors who did March 19 and March 20 was not a peer reviewed audit firm. Now, in this situation, and then because the engagement, the examination report would want a 3 years restated number plus the stub period. Now, in this situation, the SEBI will not accept a non-peer reviewed work. They would want the auditor to do at least 1 year of the non-peer reviewed work. So, which means in this situation, March 31-21 and March 31-20 at the minimum would be done by that. And then SEBI has all the right to come back to the company to ask and request their auditors to do all the 3 years again, if the peer reviewed audit firm has not done the work. Okay, continuing, then underwriters would have a lot of certifications needed. Sorry. So underwriters would have a lot of certification needed and would want a lot of certifications from the auditor's side. This is something which generally flows from the financial due diligence, and that they want comfort on that. One can have a look at that and provide the certificates. And as I mentioned, um, auditors are being considered as expert as defined under 2 subsection 38 of the Companies Act, and then they are named as experts in the prospectus as well, which carries a lot of responsibility and also carries a significant amount of risk as well. One needs to ensure that whatever the auditor is certifying is the auditor has complete backup, the auditor has full documentation, and auditor is fully comfortable in terms of what is going into the DRHP. Okay, now certain other assurance and attest function. We have, as I mentioned, the financial statements would require an audit. One is the restated, and besides the restated, there are other audits which may be required. Those, let's say, audit of the branch or audit of the other small subsidiaries is something one can look at. And then examination report, I think I have deliberated a lot. Financial information included in DRHP and RHP covered as part of the comfort letter. Circle-ups I talked about, and again there could be special request from a merchant banker or a SEBI. SEBI, as I mentioned, that they may come back to the company and ask for full 3 years of audit rather than prescribed 1 year. When I say prescribed, I mean is prescribed it is suggested in the guidance note. But SEBI can obviously come back and say do full 3 years. And then there is a due diligence call which is arranged between the bankers and the auditors. And bankers would speak to the auditors directly in terms of their independence, in terms of their processes, in terms of what risk they have identified, in terms of their going concern assessment of the company and all. This is also one thing where the auditors need to respond to and is part of the IPO process. So all these were role of an auditor in an IPO. Compliances, I think I touched upon in one of the slides. I think the Bible here is the guidance note on reports in companies prospectus revised 2019. This is the Bible for us as the auditors of the company as to what is required, what is not required, where are the templates, what is the kind of management representation letter, how are the definitions to be interpreted. So all those things are there. And then there is a compliance requirement from the Companies Act and the SEBI, as I had mentioned in my earlier slides. And so along with the responsibility, there is a huge there is we are liable for misstatements, for any misstatements in the prospectus under the Companies Act. And we will also be liable to the merchant bankers, and will also be liable to offering if the offering is done under Rule 144A of the US Securities Act. One needs to tread with caution here. There are certain other requirements which generally people miss out, or generally people have a lot of clarifications to obtain. So let's say information contained in the draft of a document and the particulars as per the restated audited financial statements should not be more than 6 months old from the issue opening date. So let's say if the issue opening date is, let's say, 20th of March, then probably 6 months old would mean 30th September is what we are looking at. And if it crosses 31st of March, then one would need to have another audited financial statements. Comfort letters will cover the financial information of the company, and it is prepared to assist the lead managers in their due diligence process. It is not part of DRHP. It is only to assist the lead managers in their due diligence process. And the circle-ups I had mentioned in the beginning are part of the comfort letters. And comfort letters are not required under the regulation of ICTR, which I've already mentioned, and so copies are not required to be filed with SEBI. Examination report we touched upon in the beginning in our example of 30th September and 31st March. Examination report would cover 30th September 2021, March 31, 21, March 31, 20, and March 31, 19. So all these 3.5 years would be covered under this stub period. And one important question that comes up is about the comparatives. The guidance note is very clear. Comparatives for the stub period are exempt. You are not required to work on, in our example, 30th September 2020. Okay, now moving on to services and deliverables. Audit of stub period I have mentioned. Examination report we have mentioned. Circle ups and grading we have mentioned. And then rely on the work of other auditors in case of subsidiaries, or in case of previous auditors, we have to follow SA 600, which means reliance can be placed on the work performed by them, but it will depend on how comfortable the incumbent auditor are, or let's say what are the guidelines by the SEBI in case the other auditor is not a peer review audit firm. Certification we have discussed, due diligence meeting we have discussed, and then performer financial statements also we have discussed in terms of the restated financial statement. Okay, now yes, certain certificates if you look at, then we have eligibility certificate, which basically talks about that we are peer reviewed firm, and then peer review certificate, then special tax benefits, if any tax benefits are available uh, to the shareholders and to the company, those needs to be there. Corporate governance compliance certificate is there. Average cost of acquisition of equity shares by the promoters, certificate on ESOP, capitalization post discovery of issue price, then allotment of shares, certification on allotment of shares, or any other certificate as agreed. So generally these are 7 or 8 certificates which an auditor should easily be able to provide. Certain other services, IPO CAs could become an IPO advisor to the company. So one could only be in advisory role. If you want to extend that advisory role and help in the implementation, one could do readiness assessment. One could help in implementation. One could do a PMO, project management office I had mentioned in the beginning. Someone is needed who understands the roles and responsibilities of everyone and who helps in coordination with all the various parties. There are lawyers, there are underwriters, there are merchant bankers, there are auditors, there is company, and then there are consultants. So someone would need to help and coordinate. Then a lot of tax related certifications is one could do. One could do a restatement advisor in terms of Ind AS advisory. If the company is currently using Indian GAAP as its accounting base, independent director we talked about. Then internal audit is one area which is very, very critical. Internal auditors, then the regulatory reviews is another area which will help. It all comes under corporate governance and help client prepare the control environment, which is the risk and control matrix chart, or the process notes, you may call it, or the standard operating procedures, you may call it. So all these things will probably help the company. A company will need someone to help and support them in their IPO process. So this is all what probably a CA should look at in terms of providing the information to the client and make them ready for the IPO. So certain other important things which generally come up is all financial information specified must be re-audited for full 1 year and the stub period by the audit certifying them in case the financial statement were audited by auditor who had not been subjected to peer review process of ICAI. Now this has been repeated again because people generally tend to miss out this clause, and then the SEBI comes up with this requirement and generally things are delayed. Now in a restatement adjustment, do we restate even the minutest of correction or an error? What are the guidelines principles on that? Now the correction of errors should be disclosed in accordance with the requirements of Ind AS 8, which is the accounting policy and changes in accounting estimates and error, and which means that you will be allowed to follow a materiality threshold. Because Ind AS 8 is very clear that if it is not material, then you are not making any adjustment. If it is material, then we are going ahead and making the adjustments, and then financial will be restated. And then Ind AS needs to be followed mandatorily. If the company is covered under Indian GAAP, we need to shift it to Ind AS. Corresponding period, I has already mentioned. For the stub period, it is clearly exempt. One is not required to do a corresponding period. However, if there is a change in the accounting policy, let's say if the company has applied Ind AS 116 in 2020 and 21, that accounting policy change needs to be shifted back to 19 to ensure consistency of presentation and disclosure, and that accounting policy of all the periods presented is in line with the latest financial statements and the stub period. And I think this I have already covered. Now, so restatements. One question that generally would come up is to what would be the reasons for restatement. One we have already talked about is the pushing back of change in the accounting policy. Second, we talked about material adjustments. Immaterial adjustments you are free to drop. Then if there are restatements for write backs made, that needs to be restated. Retrospective amendments of certain laws like Payment of Bonus Act and all, reclassification adjustments, this is extremely common. Regroupings, this is extremely common. Tax adjustments not done, tax adjustment needs to be pushed back and having a corresponding impact on the DTA. And with all the above changes, the changes in the EPS would also have an impact on the restatement. I think this we've covered, but I'll just repeat for the benefit of all of them. So incorrect accounting practices, if there is any, let's say company was required to follow revenue recognition policy, but for some reason they were not following the correct accounting policy, this would have an impact on the reasons for restatement for all 3.5 years. Provisions we have discussed. So qualifications needs to be quantified and put it into the adjustments in the restated financial statements. However, if qualifications are not to be adjusted, cannot be adjusted, then those the auditor need to take a call, and it will continue to form part of the examination report, and then a disclosure should be appearing in the notes to account. Prior period adjustments, there is no prior period adjustments in the India scenario. Those needs to be pushed back if there are any. Recomputation of accounting, change in accounting policy we've discussed. Example is India is 116. Separate disclosures for extraordinary item if something needs to be done, regrouping or tax effect, or any other disclosures which we had missed out. Those disclosures needs to be there. So what happens in a situation where there is, let's say, a negative comment in Caro? So all these things needs to be disclosed as non-adjusting item in the notes to accounts of the restated financial statements. Okay, one very important key message appearing here. In case of retrospective application, is specifically not allowed. So let's say in case of hedge accounting, it is specifically mentioned in the standard that uh, earlier application or a retrospective application is not allowed. So in that situation, what do you do? In this situation, where it is specifically not allowed, you are allowed. You are allowed to not to restate the previous year number. So let's say, for example, if the company has followed hedge accounting and it gets triggered only in March 21, you could continue with hedge accounting only in March 21, and you will not be required to do hedge accounting in 20 and 19. This is a specific exemption given, and it is appearing in the guidance note as to how this needs to be treated. And then a reconciliation of total equity and PAT and OCI for all the years is required to be given as part of the restated financial statement. And then in case of a consolidation, generally you would knock off all the related party transactions, common transactions. In a restated financial statement, all related party disclosures, even if you have knocked off in the consolidation, are required to be given. Even if those are knocked off in the consolidation, I repeat, related party disclosures are required to be given. Okay, I think this certain accounting ratios are required to be given, like basic and diluted. This we generally give. Return on net worth percentage, NAV per share, debt equity, long-term equity. So all these ratios are also required to be given in the restated financial statement. And differences in the GAAP, if there is a transition from Indian GAAP to Ind AS, that is also required to be given. And statement of tax benefits. There are certain additional disclosures which is required. Now, coming down to liabilities. So as we had mentioned, auditors are considered as experts, and if there is a statement which is appearing in the DRHP which is found to be wrong, or if we are not able to stand to that statement, there is a fine onto the liabilities onto the entire firm and not only to the signing partner, which means the liability is joint and several. There is 25 lakhs penalty, provided that an auditor has contravened such provision knowingly or willfully with the intention to deceive the company or its shareholders or creditors or tax authorities, and he shall be, and plus there is a imprisonment punishment to 1 year with fine. And we'll also be liable to, as I already mentioned, to BRLMs, to SEBI, to bankers, and then the whole firm can be debarred for up to 10 years by an AFRA, and whistleblower penalty also of 25 lakhs. I think this we've covered punishable with imprisonment, which may extend to 10 years under section 140, under section 447, and if the fraud is established and 3 times the amount involved, SEBI penalty of 1 crore, loss or damages can also be claimed by SEBI. questions?
So we'll share my screen.
Yeah. So someone can ask questions, it should be okay.
So I will share my screen that members have been like asking questions. So my screen visible, sir.
Yeah, so the fonts are very small. If you can please read it.
Yes, sir. Once. How is loss-making company shares are allowed for IPO by SEBI? How are the valuation? How are the valuation derived in this? Derived is this not promoters of such historically loss-making companies make this as a kind of business, that is do branding, highly advertisements loss, etc. to spread their names in market and then list and move out for another such company. So this is the first question.
Yeah, absolutely, absolutely. This point is very valid, and so that is the reason SEBI has said that for loss-making companies, QIB will have to do a 75%, and the retail portion will come down to 10%, because they believe that probably the retail investors will not have the muscle and the understanding of how the valuations have been worked out. There are certain rules and regulations which the companies follow, and the valuations are worked out basis that. And as I mentioned in my presentation, for a loss-making company, there are, I mean, you can't really comment with certainty as to how the valuations would frame up or how the actual would result in comparison to the valuations done. However, we have seen last year, even loss-making companies have made very big money. They have given huge money to both the investors in the company as well as to the retail investors and the people who subscribe to the IPO. So it was a win-win situation in 2021. But one needs to tread with caution if one is able to understand the valuation.
So the second question is for loss-making companies, QIB minimum 75% in QIB, the investments comes indirectly from public rights. So these loss-making companies where banks / FIs may also not prefer to finance. The IPO route is quite advantageous for these loss-making companies, right? For example, if you look Zomato, Paytm, or still in quarterly losses, post-listing, is SEBI not looking at this as public money is going in few hands? So this is the second one.
No, you're absolutely right, and this is very relevant and similar to point number one. That is the reason the window for retail investors at the time of investment, at the time of subscription of IPO, is restricted to 10% only. And SEBI has set out certain rules for loss-making companies, as we had discussed, as to how they could enter the market. But if you see, I mean, they want to offer this facility to good loss-making companies because they don't want these good companies to miss out. And then it is up to how the roadshows are done or how the valuations are done or how the merchant bankers play it. Nothing is hidden. I mean, if you see the DRHPs of these companies, Paytm, if you go through Paytm, the DRHP clearly say that company will not be making profit in the near short term. This is they have mentioned in the DRHP. So what else can SEBI actually do in this? So one needs to be beware of themselves. Next question, please.
For loss-making or even say profit-making companies, the average cost per share to the promoter is say rupees 10. Then how is the issue price determined? Say greater than 100 into, sometimes even 1000 into is allowed by SEBI?
Again, very pertinent question. I mean, it's all how the valuations are done. There are valuers who value basis the valuation rules. SEBI goes through them, and then the merchant bankers are able to sell the idea that this is the kind of valuation they will be able to command in the market. I mean, if we see, I'm not defending anyone, but if we see out of 10, 6 IPOs have been able to generate good money for everyone, the retail investors included on the day of listing. So that's how it is. That's
The fourth question is, can we refer the guidance note on a prospectus as a single stop point to have overall understand of the IPO's process?
it is a beautiful document. It is a wonderful piece of book. It will answer all your relevant questions and a big guidance to the CA community as to what can be signed and what cannot be signed and what are the templates like. Because as I mentioned, I mean, merchant banker would want you or chartered accountant to sign everything. He would want CA to sign everything, because then he is putting on his responsibility to the chartered accountant. So we need to be aware as to what we can sign and what we cannot sign. And this guidance note helps us in that process. It's very, very relevant.
Fifth question, what's the overlap of responsibility of auditors and merchant bankers, if any? How are the responsibilities shared?
There's no overlap. Auditors are required to audit the restatement and the stub period. I mean, if you crudely were to distinguish, auditors should not be stepping into the shoes of merchant bankers, or should not be stepping into the shoes of a director or a company or anyone. We are here to audit those 3.5 years, which is 3 years of restatement and the stub period. And beyond that, if there is any certification, which is the comfort required by the merchant bankers as part of their due diligence process on the DRHP. Whatever they would need is we will certify. And then to get a guide as to what we can certify and what we cannot certify, we refer back to the guidance note. There is no overlap.
As an employee of a concern going in for IPO, what are the key areas which a CA can support for going into an IPO?
Yeah, as I mentioned in many of my slides, as to how a CA can contribute. I will share this presentation with SIRC, and you guys can take my presentation from them. But just to reiterate, I mean, there is IPO preparedness, which I mentioned. A company would need someone to look into various laws and regulations and ensure whether the company is prepared. CA can contribute in terms of framing their SOPs, in framing their process notes, framing their risk and control metrics chart, advising them on their composition of board, advising them on ROC matters like compliances of meetings, compliances of changing a company from a private to a limited company, or formation of various committees, including audit committees, because private limited company will not have any kind of committee. Remuneration committees, all those advisory work can be given. And then I talked about PMO, which is the project management office. CAs can take up the role of project management, where the CAs will be required to coordinate between all the various stakeholders, including the merchant bankers, the lead managers, the other BRLMs, the underwriters, the auditors. So someone would need to help, and obviously the company. in terms of preparedness of their accounting information for audit and all. And also you could help them in preparing their Ind AS financial statements if the company is operating under Indian GAAP. So you think of it, and then there are certifications which probably an auditor will not give. So the other chartered accountant can support in providing those certificates. So there's a lot of other valuation activity. If you have passed the valuation exam, you could provide the company with a lot of valuations they would need. Consolidation is one area. It's generally considered to be complicated. Preparing notes to accounts for restated financial statement, reconciliation, preparation of restated financial statements. You think of it and you will get a lot of areas where CAs can support a company going into an IPO. And it's a lengthy process. It's just not you go there and you do that and you come back. It is not a process which is done over a month. It takes about a year or 1.5 years. So that is the kind of length of services which you could try and sell.
That's all for the questions, sir. That's all. These were the questions, sir. Actually.
Sure. Thank you.
The secretary is like join. 1 second, sir.
Yeah.
Yes. So that was an excellent presentation, sir. And in a very short time, you have done more than justice for the topic. And also, I hope the members are also very much happy with the presentation, and because they are enriched. With this, I thank the chairman for selecting this topic for this today's webinar, and also the CP committee for that. And very heartful thanks to you as a speaker, sir, Amitji. So we keep in touch with you, and if at all any more information or help is required from your side, definitely we will take your help. And also thank you for sharing the PPT, because many members are asking, there may be so many doubts, because as you rightly pointed out, it is very amazing to see that 65 to 67% of the IPOs hike in the last 1 or 2 years is really an area where the chartered accountants have additional opportunity of serving the clientele, both as employees and also as practitioners, and to equip themselves. As you rightly pointed out, one more thing, that it takes minimum 1 to 1.5 years working on these lines. So thank you very much for taking the members into this area and explaining the intricacies in this area so succinctly. And definitely there would be, if at all there are any issues raised by the members, we will forward those issues to you through to your mail ID. Please help them out in clarifying their doubts. So with this, you have done a great job today. Thank you very much once again. And I thank all the members also for being part of this program, despite the busy schedules of tax audits. Thank you very much. Thank you, one and all. And also I thank Selva and Monica ji for back office support, and the SIRC office for all the support. Because sitting in various places, we are able to learn these things through technology. So technology has helped us so much to connect ourselves. So thank you one and all for this excellent program, making it a success. Thank you, sir.
Thank you, Panaji, for having me here. Thank you so much. Bye bye.